Traditional investment advice is to buy and hold a diversified portfolio of stocks and bonds, and that over the course of time, after enduring all the market's ups and downs, you'll eventually reach your investment goals. I think there's three problems with this advice, and it has to do with the underlying assumptions about risk, return, and diversification. Let's take a closer look at each one of these factors. When it comes to risk, most people believe the longer they're invested in stocks, the lower their risk. This is false. In fact, risk increases with time, it does not decrease. You actually know this intuitively. Just think about any risky activity. Take driving your car, for example. Is it safer to drive 10 miles or 1,000 miles? What about skydiving? Is it safer to jump once or 1,000 times? Risk increases with time, it doesn't decrease. If you're interested in learning more about this concept, the math behind it, and how it relates to the stock market, Professors Lobos Pastor and Robert Stanbaugh wrote a paper in 2011 called "Are Stocks Really Less Volatile in the Long Run?" Click on the link below to download the paper. The second problem with traditional investment advice has to do with the underlying assumption about investment returns. Most people think that in order to be successful, they need to stay fully invested in stocks all the time so that they don't miss out on the stock market's very best periods. I think this advice is backwards. Don't get me wrong, it's important to be invested in stocks during bull markets. You should be. My point is that it's far more important not to be invested in stocks during their worst periods. Successful investing is not so much about how much you can make in up markets, it's really about how much you can preserve in down markets. The great Warren Buffett had a wonderful quote. He said the two rules for investment success are: rule number one, don't lose money. Rule number two, don't forget rule number one. Asset preservation is the key to long-term investment success. The third problem with traditional investment advice has to do with this assumption about diversification. Most investors are told that in order to be successful, they need to diversify their portfolio among a very wide range of asset classes. For most investors, I think this is over-diversification. In fact, the way to achieve outsized returns is to concentrate assets in areas that are likely to perform well and avoid areas that are likely to underperform. By attempting to invest in the right asset classes at the right times, investors can achieve a balance between concentration and diversification. So, these are the three problems as I see it with traditional investment advice. I hope you liked the video, and if you want to learn more about active investing, just visit our blog at calculated-success.com.